Successful traders are aware of the risk they will take on each trade and reward they will receive prior to executing a transaction. And it's very core to implication of the risk and reward in the trading are very simple. You objectively evaluate the amount of the capital you wish to explore and evaluate the potential for reward against the risk capital. Ideally, the trade should only be excluded when the application gain the reward from the trade match the exclude the risk being taken. But it's not this simple. In today's video, I will show you the future trades based on the risk reward using the price actions, so you can protect your guarantee increasing your trading account. It is fairly common to see traders often complicated to the perspective of risk and reward leading to complex and often bad decisions making on their trading. A primary reasons has to go with the subject nature of the reward element of the analysis. So let's discuss about each of them. First, let's address the risk factor on in your trading. This is relatively easier than the razor objective tasks for the trader to determine the profit, the portion of the capital to be risked on the trade. For most traders, it is usually to fix the percentage of their capital, for example 1% or 2% per trade. For some advantage traders who understand the varying probability of the success in different trade setup, the risk factor could be different in the range, for example, from 0.5% or an aggressive trade setup to 1% to 1.5% for more conservative, higher probability trades. Obviously, there will be other factors to consider as well, like the frequency of the trading queue, individual risk appetite, nature of the trading, and success capital mean how much money you have at your deposito for trading or investment. But no matter how many factors you put into subjects, the aspect of the determinant your risk per trade is usually a straightforward process that you are usually able to figure out with some basic trial and error. Now let's consider the percentage of the reward factor, which is usually the bigger problem for most traders who struggle with the using risk and reward effectively in their trading. The reason of the reward aspects gets tricky is because it is virtually impossible for the trader to determine before what the outcome on the trade will be, hence making it technically impossible to arrive at the objective risk to reward ratio for the trade setup. An example would be the implemented the market with 1% risk and closing the trade out with a 2% reward. But such methods are usually used by the traders who don't use market developments and the price actions as the core principle for their exit strategy. We are better than that, so we are the reward based on the price. So how can the trader safely assume the particular risks to reward ratio on the trade? There are two simple techniques. A common method that I often successfully implemented by my traders is using the first support resistance area approach. As the name of itself suggests, the first support resistance area for the trade would be the closest level of the trader believes could possibly hold the price, resulting in the worst case. In the bonus of the level, threatening the variability of the trade area. This approach calls for the trader to assume the conservative outcome for the trade. That is, the market will bonus from that area, assuming that in the situations like this, you would be action to close out the trade. could employ the distance from the entry to this first support resistance area to arrive at an optimal risk-reward ratio for your trade. This example illustrates the first support resistance area approach. Let's consider you want to sell the close of this bearish pain bar candlestick pattern with the stop loss above the high of the pin bar and the first support resistance area being used to evaluate the conversative reward value to the trade. This region represents the risk of the trade, and it represents the potential reward by comparing the areas based on the first support resistance area approach. We want the setup by yelling the near one-to-one risks reward ratio. You can observe that the mistakes actually pushed a little lower than the first support resistance area, but that's irrelevant because the conversative exit occurs right at first support resistance area. Now, very important, the general problem that trades often face with this approach is that the first support resistance area is usually not be far enough from the result in the one-to-one or better risks reward ratio. If you find yourself the similar setup and the reward is lower than the risks, skip up the trade. Now let's consider the alternative approach that does appropriate a bit more flexibility to the trade, and that is the major support resistance area. For practical traders, traders might be confident that the more further away to the first support resistance area possibility because of the strength of the setup, which should ideally reflect in the risk to reward ratio. This approach calls the trader to calculate the distance between the entry and the major support resistance area that he anticipates price to be reaching at. The major support resistance area could be the first support resistance area or the upcoming important area further away past to the major support resistance area. So let's take example to demonstrate the approach. In this case, the trader is not now looking past to the first support resistance area toward the major resistance area as shown here. Assuming the same setup to the trading plan, you will notice that here reward area is now noticeably larger than the risk area, thereby yielding the risks reward ratio better than 1-to-1. The market did actually make it to the major support resistance area, and in this case the second approach would have worked better. The advantage here is more realistic risks to reward ratio that accounts for the trader's own expectations of the outcome of the trade. However, on the Philippines, it also requires a sound judgment from the trader. For newer traders, this can be hard to achieve as very trade takes normally expect to perform very well, mainly as a result of the emotional rather than the advincedly drive from the pre-volatility market conditions. For those traders, following such strategy will often result in the artificially attractive risk to reward ratio that are not very useful. So how do you find the air to air ratio that works for you? As general recommendation, it would be wise for never traders to be in with the more conservative measure of the risks to reward ratios as they determine the first support resistance area approach, and gradually with the experience that are resuming confidence and could add both the advanced measure support resistance and the approach to the more realistic measure. While this is the holy grain to finding the perfect reward to risk ratio, a good place to start is to look at your win rate. Before you can expect your risk ratio to work for you, you must first confirm that you can win often enough to eventually hit the potential reward. For example, using 1-to-1 risk ratio means that your potential profit is as big as your potential loss. This will only work if you're out of the right at least half of the time historically. Bear in mind, is a risk to reward ratio 1-to-1 means nothing and depends on the exact trade action. Is therefore more logical to be using strategy that allows you to arrive at realistic numbers of it means having to the past to the trade setup due to the low risk rewards. A heavy mindset is to avoid being optimistic so when you get into the trade. Common mistakes many traders make in they pick a very distant take profit level or use a stop loss that took thing just to create a larger risk reward ratio. Of course, this leads to the several problems. First, price can't reach the overly optimistic target levels, you will give back profits, and secondly, price takes out the loop conservative stop loss and then continue onto your initial profit level, but leaving your with the nothing behind is both cases in the target has created the illusion of the potentially increased trades. Very often traders use the large potential ratio to reason themselves into the trade strategy shouldn't be in the end. They take the potential large payout of the exclusive to be in their trading rules. Before you brought the entire trades, push the few moments and make sure that you have set your orders to a realistic way based on the price actions and you are not violate your rules. Always remember that the rewards ratio must be taken into context and has to do change on the trade to the trade basis. Trades often try to use shortcuts and set to the fixed route to their take profit and stop loss orders to come up with the same risk reward ratio every time. However, the way you place your profit and stop ordering has to change based on the chart context. If price is about to run to support area, you should consider the setting your profitable target ahead of the level to reduce the likelihood of the price missing your target. If price is near the resistance level, you can set your stop on other side of the barrier between the price your stop, always using the same amount of the points your stop can quickly lead to the problems when you don't take support resistance or the other chart factors into context. Also, when you don't adjust your profit target based on the price chart in front of you, you can easily make the mistakes of the placing the order strategic bet and had to reach the areas those. Instead of the using fixed risks reward ratio with the fixed rules of your stop and target, work with risk reward ratio. Therefore, instead of the adjust your orders based on the current price charts and the price context, as always, if you find something new value, leave us a like to show your support and subscribe to our channel to hit the bell icon to stay notified when we upload next video. Until next time.